The bank that will break the world. Why the secret collapse is already underway. The line's dead, liquidity's gone. Silence, screens lock, quotes vanish, and a room of veterans stops breathing. On a secure bridge between central banks, a voice breaks, do not publish the rate. Order books go hollow. Repo fails detonate in minutes. This isn't a hedge fund, it isn't housing. The fire is inside the fire station and the hoses aren't turning on. Here's what no model priced. The bomb isn't rates or inflation, it's collateral and the hidden leverage coiled inside a central bank nexus. Stay with this because in the next 8 minutes you'll see the timestamp they ignored, the players who moved early, the domino route across oceans, and the obscure clause that explains why they watched it burn. The fire alarm that didn't ring. It starts as a routine operation. A standard morning liquidity ad the kind markets ignore. Dealers submit bids a little elevated but nothing dramatic. Then the clock runs, 5 minutes turn to 20, the size isn't announced. Phones that never stop buzzing go quiet. One repo desk head texts arrival, you seeing this? The reply takes too long. That's when traders begin pulling lines, not because they know but because they don't. Why it matters is simple. When the backstop hesitates, the price is built on that backstop wobble. Every mortgage, every swap, every bond priced off the smooth flow of funding suddenly looks like it's standing on glass. Collateral that traded yesterday at a small discount needs a bigger haircut today. Basis spreads, normally boring, start to breathe like panic. On the official channel, the phrase is policy transmission frictions. It sounds tidy. Inside the pits, it feels like collateral scarcity dressed in a suit. There are bills, there are notes, there are bonds, but the specific pieces everyone needs to finance positions are stuck. Specials go more special. General collateral drifts above policy. The overnight reverse repo facility pulls like a magnet while dealers beg the right CUSIPs to cover shorts. No one wants to say it, but the market's map of safe assets just shrank mid-session. Meanwhile, pension risk officers who sleep near their phones sit up. A margin email hits at 3:18 a.m. local time for a fund that promised steady returns. The finance chief calls the Treasury desk, who calls their clearing broker, who's already raising haircuts because their prime brokers are raising haircuts because their banks are watching their leverage constraints. You can feel the cascade before you see it on screens. What nobody saw was the dependence tucked at the core, maturity transformation hiding in plain sight. The institutions we call long-term were financing long with short pipes, counting on the smoothness of the backstop to roll forever. Every day is yesterday until it is. When the curve shifts and liquidity thins, small funding mismatches turn into job-threatening gaps. That's when lines get yanked, not because someone's insolvent, but because the pipes can't carry the load at today's speed. On one desk, a basis trader had the perfect hedge. Long cash bonds, short futures, carry paid by a few basis points, leverage multiplying the boring into a business. It works when repo is a utility. It unravels when specialness spikes and the special you need can't be borrowed at any price that keeps the math whole. He hits reduce, but the street is doing the same trade and the exits narrow. The phones that fall silent tell you more than the calls that get through. A senior repo trader keeps a mental list of who blinks first in every past scare. He dials 2 names. Voicemail. He tries a junior who answers with a clipped "we're flat." Translation, we're done extending. At a clearing bank, an internal dashboard shows fails ticking up, first tens of billions, then more, while a compliance window flashes alerts about concentration. Officially, nothing's wrong. Unofficially, desks start pricing, and what if the operation doesn't show? Another 10 minutes pass. One bank's treasury desk pulls back from term quotes. The price for certainty jumps, haircuts, those quiet percentages in footnotes move a notch, then 2. Value at risk models, tuned to recent calm, begin thinning inventories because the model says this is not the day to be heroic. Here's the whisper no one writes down: central banks are dealers now. The facilities designed to support market functioning have become the market for last resort. When they hesitate, it's not a signal, it's a vacuum. Dealers whose balance sheets are capped by leverage rules can't suddenly double their capacity. They won't. So market depth collapses faster than the headlines can form. Behind the glass, a policy team watches spread monitors, not just inflation charts. The choice is ugly. Step in, widen collateral eligibility, and confirm that the market depends on you. Or wait and risk a bigger break that forces you to do the same thing at scale with more stigma and less time. Someone argues the rulebook. Someone else says, we'll rewrite it if we have to. To understand the silence, we need to go back to the blueprint. The part written when emergency playbooks from 2008 to 2012 turned into permanent architecture. Balance sheets became policy tools, and pipes were replumbed in ways that made the system smoother, until stress demanded the old flexibility from a market that had handed it away. But before we rewind, stay with that room for one more moment. The head of funding for a mid-sized insurer tries to borrow against sovereigns that were considered pristine last quarter. The screen flashes a higher add-on. He looks at his calendar of liability payments and knows he can meet everything if he can roll today. He calls a relationship banker who says, carefully, we're reviewing limits. He doesn't shout, he writes down the time. The fire alarm didn't ring, it stuttered. And in markets built on the idea that the alarm always works, a stutter is enough to move billions, to change careers, to set off hedges that weren't supposed to matter. The backstop is still there, it always is. But the hesitation revealed the truth. The system's calm depends on collateral that's scarcer than the speeches admit, and leverage arranged around the assumption that the fire station never burns. The blueprint: how a backstop became the market. To understand the silence, we go back to the moment the manuals changed. After 2008, what started as emergency improvisation turned into architecture. Central banks didn't just cut rates, they re-engineered the pipes. Facilities with sunset dates got extensions. Acronyms that sounded temporary became household names on trading floors. The lesson markets learned wasn't subtle. The referee could step onto the field and play the ball. Here's the hinge: before the crisis, balance sheets were signals. After, they became instruments. Quantitative easing wasn't a headline about cheaper mortgages, it was a plumbing job. The central bank bought duration from the market and replaced it with reserves. To the public, that looked like stimulus. Inside the pipes, it changed who held what and how funding moved. Duration left private balance sheets. Reserves swelled at banks that didn't need them for lending but needed them for regulation. When you flood banks with reserves but remove swathes of safe collateral from circulation, something subtle shifts. Private dealers who used to intermediate flow and warehouse risk now face a different balance sheet math under tighter leverage rules. Their capacity to absorb shock shrinks. Meanwhile, the demand for pristine collateral rises because margining regimes ask for it, regulators prefer it, and every model assumes it trades like water. The loop tightens: reserves up, safe collateral down, intermediation thinner. Quantitative tightening tried to reverse it, but not symmetrically. You can drain reserves, sure, but the market's habit has already changed. Participants who rebuilt their strategies around abundant backstops and predictable pipes don't pivot overnight. Hedge funds built basis trades that relied on smooth repo. Pensions and insurers hedged duration in ways that required rolling collateral day after day. Banks, constrained by leverage rather than risk weight, rationed balance sheet space. The capacity that left didn't simply return with a press release. Meanwhile, something else happened in plain sight. The market functioning mandate widened quietly. In 2008, purchases came with the language of panic. By 2012, they arrived with phrases about transmission and functioning. In 2020, the language carried an implicit promise: if functioning slips, we'll step in across asset classes. Not permanently, they said, just until stability returns. But each step changed expectations. The line between lender of last resort and dealer of last resort blurred. This mirrored what BIS quarterly reviews later dissected as market functioning interventions across sovereigns and credit, and what the Federal Reserve's own 2020-2021 facility reports framed as temporary operations to preserve transmission under extreme stress. Get this: policy communications started targeting plumbing, not just pricing. A speech about tapering could widen mortgage spreads if dealers believed inventory would pile up. An offhand remark about technical factors could move repo rates more than a full meeting's decision. The market wasn't listening for the old signals. It was listening for clues about pipes, collateral, and balance sheet elasticity. Every sentence became a forward guide to liquidity conditions. There was also a moral hazard migration. Classic bank risk, boxed in by capital and liquidity rules, bled into non-banks. But the funding pipes didn't change nationality. They still ran through banks, clearinghouses, and collateral chains anchored in the same sovereigns. The risk shifted venue, not system. A hedge fund's leverage might be private, but its financing lives in the same repo markets that a dealer taps, which live under the same central bank umbrella. The map looked diversified. The pipes weren't. The result? 3 structural cracks formed while everyone pointed at inflation, growth, and unemployment. First, collateral scarcity tucked inside abundant reserves, an illusion of plenty with the wrong kind of plenty, a pattern highlighted in BIS work on safe asset scarcity and repo market segmentation. Second, leverage where supervisors didn't have direct line of sight, interacting with margin models that assumed liquidity, a recurring theme in FSB non-bank financial intermediation assessments and IMF global financial stability reports. Third, fiscal realities pressing into monetary plumbing via issuance patterns that dealers had to digest with balance sheets. They no longer had echoing Fed staff analyses of SLRG SIB constraints and primary dealer capacity. Each crack was rational, each step defensible, each memo clean. Together, they made the system brittle. Look at the timeline. Emergency lending facilities in 2008, asset purchases scaling in 2009, forward guidance mixing with balance sheet policy by 2011. Sovereign stresses in Europe forged a template for market functioning interventions beyond banks. In 2013, a taper tantrum reminded the street that communication itself was a tool with teeth. By 2019, standing-like features appeared in repo to smooth spikes. In 2020, everything accelerated. Corporate credit backstops, municipal support, foreign swap lines expanded. Each program aimed at functioning. Each one widened the doorway. Language changed too. Transitory support became ensure market functioning. Then support financial stability entered routine statements, not just crisis minutes. That shift mattered more than 100 basis points. It told traders there was a line, but the line moved with functioning, a word flexible enough to fit the moment. The mandate in practice grew teeth where the market needed them. Collateral eligibility broadened, maturities lengthened, haircuts softened, until the day they tried to normalize. Here's the quiet irony. Normalization preserved the architecture. Even as purchases slowed or reversed, the present stayed. A standing repo facility signals capacity. A daily balance sheet report becomes a market data point. Dealers model their limits around what the central bank might absorb or accept. Risk officers write policies with clauses that reference facility access if available. Nobody intends dependence. Dependence is the sum of thousands of rational policies written after the same shock. Now the psychological hinge. Temporary became a comfort word that trained behavior. A junior policy analyst drafts a memo with 3 phrases: temporary, targeted, technical, because that's how you get a green light. A senior trader reads those words and relaxes inventory because that's how you keep your job. A risk officer adds a footnote: facility access if available, because that's how you pass committee. Every time the word shows up, someone takes a little more flexibility for granted. The habit sets like concrete. Inside rooms with no cameras, the tension is personal. One governor stares at a depth monitor that looks thin and says, "We can't let this slip." Another points to a statute and says, "We can't live here forever." A lawyer taps a clause about functioning and says, "We can for now." The decision lands in the same place: act now, define later. It's not conspiracy, just humans choosing the least career-risky path in a system that rewards immediate calm. So when a morning operation runs long and the line goes quiet, the fear isn't abstract. It's the realization that the backstop became the market through years of well-meaning carpentry. The blueprint replaced wood with steel, removed doors, widened others, and labeled it temporary. Then everyone moved their furniture to fit. Now when the hinges squeak, it isn't about rates. It's about architecture. And architecture, once lived in, doesn't revert without breaking something people care about. Crack 1: Collateral scarcity and the repo choke. Here's where the pipes tighten. On paper, there's trillions in sovereign debt outstanding. In practice, the pieces that matter, on-the-run bills, specific notes, the CUSIP's hedges are built around, can vanish at the exact moment everyone needs them. When that happens, funding costs detach from the policy rate like a boat slipping its moorings. Your central bank can say 5.25% all day. If the collateral you need goes scarce, your true price is whatever gets you that piece tonight. The tug-of-war starts with bills and the overnight reverse repo facility. Money funds love the certainty of ONRRP, pristine counterparty, clean collateral exposure, no balance sheet surprises. Dealers, meanwhile, need those same bills to finance shorts and hedge inventories. When the ONRRP rate sits just attractive enough, cash migrates into the facility instead of into dealer repo. That pulls lendable cash away from the street, right when specials are getting tighter. General collateral inches above policy, then specials rip. Specialness sounds quaint until it blows a hole in your model. A particular 2-year note goes from minus 30 basis points to minus 200 against GC. If you're short that note as part of a basis hedge, you either find it or you pay through the nose. Fails start creeping up. First it's a rounding error, then settlements miss in size that makes risk officers sit up. The fails charge, designed to keep the system honest, becomes a real line item. People stop rolling term because tomorrow looks worse than today. Dealers used to lean into this. They'd warehouse inventory, make markets, and smooth the spikes. Now leverage constraints cap their balance sheets in a way that ignores how safe the assets are. SLR, GSIB buffers, internal risk budgets, pick your acronym, the result is the same. Capacity doesn't expand just because spreads do, so depth thins, a 3-tick market becomes a one-sided screen. Quotes show, then disappear. If you need a bid, it's smaller. If you need an offer, it's gone. Meanwhile, the basis trade, the industry's quiet workhorse, relies on those smooth pipes. Long the cash bond, short the future, clip the basis, funded in repo, lever it enough to matter. It's a utility trade when funding is stable and specials are tame. But the second specialness spikes, your carry turns negative. Haircuts widen as clearing brokers protect themselves, and the leverage you used to make pennies look like dollars flips on you. The math that made sense at minus 20 collapses at minus 180. Here's a human moment. A mid-level basis trader sits with a spreadsheet he's trusted for 5 years. He's got liquidity ladders, term funding, counterparty diversification. He's not reckless. He was told this is as close to risk-free as the sell side gets. Then the CUSIP he needs goes no offer. His prime calls, haircuts up 2 points across the book. He has collateral, but not the right collateral, and the wrong kind costs him time he doesn't have. He trims size. The market trims with him, prices gap. Now layer in settlement mechanics. Fails concentrate in the most used hedging benchmarks. Clearing agents flag counterparties. A few big players pull back from term trades, pushing more volume into overnight, which magnifies the daily scramble. General collateral prints above policy in the morning, then collapses in the afternoon when the facility reopens and window dressing kicks in. Volatility in the plumbing leaks into volatility in spreads. Basis moves no one hedged for start showing up in P&L that was supposed to be boring. Central bank facilities drift into the frame. The standing repo facility meant as a ceiling looks like a lifeline, but stigma isn't gone, it just hides better. Banks weigh optics against opportunity and not everyone can access the window directly. So intermediation bifurcates, those with direct lines price one way, those without pay up. The facility becomes a de facto dealer. Its rate sets the top, its eligibility list defines what money-like means this week. That subtle signal reshapes balance sheets in real time. The Fed's standing repo facility SRF, formalized in 2021, and counterpart arrangements abroad were explicitly characterized as backstops for money market functioning, not as primary funding sources. Yet their mere presence influences private pricing, as BIS and Fed notes have observed. Here's what nobody wants to state plainly. The ONRRP grabbed cash precisely when the street needed it, and it did so by offering the safest collateral alternative in town, none. Money funds exchange cash for a claim on the central bank, not for bills that can lubricate trades. That's policy design, not malice, but the consequence is real. The more comfortable cash feels at the facility, the less patient it feels with dealers. The equilibrium tilts towards scarcity, not flow. And when scarcity bites, haircuts become policy. A 2-point change on a supposedly pristine bond is a tax on leverage. That tax cascades. Prime brokers widen further to shield themselves from client fails. Clients dump liquid to fund a liquid. Dealers starved of balance sheet step back. Futures decouple from cash. The ARB isn't an ARB, it's a liquidity bet dressed up as math. Everyone knows the central bank could ease the choke by lending the right CUSIP or widening eligibility. Everyone also knows the price of that fix, deeper dependence. Meanwhile, general collateral's drift above policy starts to matter for real borrowers. Mortgage REITs see funding costs that don't match the speeches. Corporates rolling CP notice bid-ask moving in ways their treasurers haven't had to explain since the pandemic. The transmission mechanism bends. It still works, money is money, but it's delivering a different message. Availability beats price, and the definition of availability is shrinking to what the pipes can carry today. The crack isn't theoretical. It's a structural mismatch between abundant reserves and scarce collateral, policed by leverage rules that don't flex in panic and amplified by facilities that siphon cash from the street. In calm, that looks like safety. Under stress, it looks like a choke. And once you felt it, you don't forget. You short maturities, you hoard the on-the-runs, you pay up for certainty that used to be free. That's how a basis point problem becomes a system problem, quietly, then all at once. Crack 2: non-bank leverage that regulators don't see in time. While funding tightened in the pipes, a second crack grew in the shadows. It lives where mandates meet math: pensions, insurers, hedge funds, institutions built to be patient, forced by rules and promises to play duration games with short-term tools. On paper, they're strong. In practice, they're leveraged to collateral liquidity that disappears the moment screens turn red, and when it disappears, the fear isn't theoretical, it's a timer. Start with pensions. They promised liabilities decades out, so they hedged rates with derivatives rather than dumping cash into bonds. That's liability-driven investment, LDI. It works when collateral is easy. You post gilts, receive the rate hedge, keep the asset mix you like. As yields rise, your hedge loses value and the clearinghouse asks for cash variation margin. Normally, you raise it by repoing more gilts. In a squeeze, repo haircuts jump, specials tighten, and the cash you expected to borrow at a whisper now screams. The request says by close. The clock on the email is the scariest number on the screen. Here's the play-by-play everyone pretends was a one-off. Yields start marching higher. Gilt futures gap. Margin calls hit inboxes before breakfast. Pensions sell the most liquid thing they own, more gilts to raise cash. Selling pushes yields higher, which triggers more margin, which forces more selling. Prime brokers lift haircuts mid-spiral to protect themselves. Clearing members start asking who their clients' are. The spiral tightens until the central bank buys for functioning. The language avoids the word bailout. The effect is the same. The lesson is worse. Everyone now knows the panic clock can force a sovereign to blink. The FSB and BIS postmortems on the 2022 UK LDI episode documented this procyclical margin dynamic and the necessity of temporary gilt purchases to restore functioning. Insurers run a cousin of the same strategy. They hold long assets against long liabilities, but they manage capital with derivatives and collateral schedules that assume markets will take their collateral at known haircuts. Their models, solid and calm, imply liquidity on demand. When the special they pledged as high-quality liquid asset turns special in the wrong direction, their internal liquidity ladders suddenly have missing rungs. They're solvent. They just can't post what the system wants at 2 p.m. today. The fear isn't default, it's delay, and delay is punished like guilt. Hedge funds, meanwhile, are the system's shock absorbers until they aren't. Basis trades in rates, credit index tranches against ETF baskets, curve steepeners funded in rolling repo, all leverage small edges into meaningful returns. Risk is managed daily, sometimes hourly, through prime brokers who can pull financing faster than any bank regulator can call a meeting. The oversight is indirect. Margin models, counterparty limits, disclosure with a lag. When volatility spikes in the plumbing, these desks become forced sellers of the liquid to protect the illiquid. Funding calls arrive as terse bullet points. The subtext is panic. Margining models sit at the center. They're calibrated on recent realized volatility and liquidity assumptions that treat collateral haircuts as slow-moving. Under stress, liquidity becomes discontinuous. The model says post 20% more. The market says also your posted collateral is worth less at our desk right now. That wedge is where spirals start. It's not fraud. It's a timing mismatch with a megaphone. The psychology is simple. Pay now to avoid a worse email at 3:58 p.m. Now remember the LDI shock's final act. The central bank stepped in and bought long gilts to restore market functioning, promising sales later, limiting size, and setting an end date. It worked. It also taught a lesson. If a non-bank margin spiral threatens core rates markets, the dealer of last resort extends beyond banks. That embeds moral hazard. You can design better liquidity buffers. You can still model your strategy around the assumption that in extremis, the referee will play the ball again. Everyone denies dependence. Everyone budgets for it. Here's a human moment to ground it. A pension CIO watches yields tick through levels that were stress scenarios on last year's slide deck. He calls his LDI manager. How much? The number isn't ruinous, but the timing is brutal. Cash by close. They sell a liquid credit ETF because it trades tight. The ETF price gaps wider than the underlying bonds because the ETF is the only place you can get size now. Members won't see this screen, but their fund just paid for time. He stares at the timestamp on the margin email and writes it down next to the word, never again, knowing he'll be back here. Non-banks don't live off the grid, they live at the end of the same pipes. Their leverage is funded by banks and brokers. Their collateral is evaluated with the same models. Their margin calls flow through clearinghouses that were built to be safe by demanding cash now. Regulators see parts of it in quarterly reports, stress tests, filings that describe risk at a distance. What they don't see in time is the intraday slide from manageable to mandatory, the missing 2 hours between tight and tap everything. And it's not just one country's quirk. Similar structures exist across USD, EUR, and JPY markets with local twists. In the dollar world, credit ETFs and TRS desks tie together retail liquidity and institutional leverage. In Europe, pension hedging and insurer solvency regimes create procyclical demand for high-quality collateral at the worst moment. In Japan, yield curve control shapes collateral availability in ways that suppress volatility until it returns in a rush, spilling into cross-currency funding as investors hedge FX with swaps that widen under stress. The hidden debt is everywhere. It's just booked as promises that assume tomorrow's repo works like yesterday's. Meanwhile, swap lines wait in the background for a dollar squeeze, but they're not designed for a non-bank margin cascade. They ease bank funding. They don't write variation margin checks for a fund in London holding Danish mortgages funded against euro collateral. The relief routes are diagonal, not direct. That lag matters in a world where a prime broker's email can change the size of a balance sheet in an hour. The gap between authority and need is measured in hours, not policy cycles. IMF and BIS analyses of dollar funding stress repeatedly note that central bank swap lines stabilize bank balance sheets, but reach non-banks only indirectly via intermediaries. So the second crack is clear. Leverage that lives in mandates, hedge the duration, target the spread, financed by pipes that demand perfect collateral in a system where the backstop signaled it will stabilize functioning even if the trouble starts outside banks. It's stable until a small miss becomes a system-level margin call. And when it comes, the call isn't answered by a press conference. It's answered by whoever can meet cash today, and by whoever learned to fear the timestamp more than the headline. Crack 3: Fiscal Dominance wearing a monetary mask. While leverage built in the shadows, a third crack widened in daylight, deficits whispering instructions through the pipes. When governments borrow at a scale that sets the ceiling, independence turns into theater. The central bank still sets the policy rate, still gives speeches about inflation targets, but the stage is crowded by a simple fact: someone has to sell the debt, roll the debt, and keep the auctions smooth. The plumbing hears that louder than any press conference. Watch maturity. When deficits run hot and rates climb, treasuries shorten what they issue. Bills grow because they're cheaper to print today. That transfers rollover risk from the sovereign's long horizon to money market's daily clock. It looks prudent in a spreadsheet: lower interest costs, flexible issuance. In the pipes, it's gasoline. More bills mean more competition for cash. Money funds feast, dealers starve, and the tug-of-war with the central bank's facilities intensifies at the worst time. Now pair that with quantitative tightening. The central bank drains reserves while the fiscal arm floods the market with supply. Dealers stand between, asked to absorb a wave with balance sheets that can't widen on command. Auction days start to wobble, tails widen a few basis points beyond comfortable. Coverage ratios look fine until you read the allotment, more paper goes to fewer hands. That concentration is a tell. The street is rationing risk. Inside a debt office, the strategy is sensible. Smooth the curve, meet demand, avoid signaling panic. But meeting demand assumes dealers can intermediate without breaking. They can't if leverage rules and internal buffers say no, so they nudge. Phone calls that aren't orders sound like, "We've heard feedback about market functioning in the long end." A central banker nods, repeats independence, and mentions technical factors. Markets read the tell anyway. Here's how QT meets issuance in real time. The central bank lets a slug of bonds roll off. The Treasury replaces them plus the deficit. Primary dealers take their share but push back at size. They bid defensively, widen concessions, and warehouse less. Secondary liquidity thins. The next auction leans heavier on indirects or directs. On screens, tails grow. On desks, people say, "We need some help." The help can't be a rate cut. The help is elasticity. Collateral terms, repo windows, flexibility in who can fund what. Meanwhile, bill-heavy issuance pulls cash into overnight products at the central bank's own facility. That's a loop no one intended. Fiscal financing choices deepen the cash drain from dealer repo, tightening funding as supply rises. The policy rate still anchors statements, but the effective price of balance sheet moves away from it. Repo clears dear, term shrinks. The market learns a new priority: clear the government's calendar first. Here's a human angle. A Treasury official slides a chart across a table: projected bill share, duration profile, expected savings. The central bank team counters with a chart of reserve scarcity, GC spreads, and fail rates. Both charts are right, both can't win. The official says, "We can't afford a failed auction." The central banker says, "We can't afford to ink a backdoor pivot." The market hears both sentences and prices the path of least embarrassment. Fiscal dominance isn't a coup, it's a slow squeeze. Each quarter, issuance overshoots capacity by a little. Each month, auctions clear with just enough concession to bruise. Each policy meeting, the language bends toward functioning over level. That drift cages the inflation fight. If inflation runs hot, hiking into choked liquidity risks a funding accident. If inflation cools, easing to grease issuance looks like capitulation. The trap is optical and real. Auction mechanics make it visible. Dealers lower their takedowns unless compensated. Bid to cover holds because real money and foreign reserve managers step in until they don't. One weak print gets called technical, another seasonal, a third holiday-related. Everyone knows the euphemisms. The truth is simpler. Balance sheet is expensive and the marginal buyer is tired. Without elasticity from the dealer of last resort, tails keep flirting with discomfort. Specialists watch microtells. Fails rise on off-the-run issues used as collateral at the same time long-end auctions cheapen. Assigned dealers are gapping inventory to make room. Swap spreads invert in odd places, signaling demand for balance sheet-light hedges over cash bonds. Cross-currency basis widens on issuance days. Foreign demand wants hedged exposure but balks at the cost. Each sliver is small. Together they spell strain. So the mask slips. Independence remains in law, but practice bends around financing reality. The central bank widens collateral eligibility temporarily, extends maturities in facilities to support functioning, and treats bill saturation as a parameter, not a problem. Inflation tolerance gets a quiet halo. Drift within the band is fine if the market breathes. The price of peace is paid in basis points and credibility points, and the invoice lands in money markets first. Here's the line traders repeat under breath. "We don't fight the Fed, we fund the Treasury." It's a joke with a ledger. Corporate treasurers front-run tight windows, shortening their own maturities. Utilities hedge less tenor because long-end liquidity costs too much. Banks sit on HQLA that doubles as optionality. Everyone adapts to the regime where functioning ranks above purity. That's fiscal dominance wearing a monetary mask. No announcement, just a series of small, rational choices that make the next crisis response inevitable. The long game, how temporary became the plan. 3 words changed the culture just this once. That's how emergency tools crossed the line from exception to expectation. In 2008, it was temporary liquidity. In 2010, temporary securities purchases. By 2012, temporary market functioning operations. The calendar dates moved, the word stayed. Traders stopped hearing temporary. They heard template. Start with the facilities that were supposed to vanish. Term auction credit, crisis repo backstops, dollar swap lines with friendly central banks, all built with sunsets. Then came extensions. Conditions hadn't normalized or normalization risked relapse, so sunsets slid. The logic was tight: remove the crutch after the patient walks. But the patient learned to plan around the crutch. Each extension bred policies downstream, funding ladders, collateral policies, counterparty limits that assumed the crutch could reappear overnight. Eligibility creep did the rest. In the early days, collateral lists were narrow. Only the cleanest claims could touch the window. Then market functioning needed flexibility, so lists widened. Agency MBS joined sovereigns. Later, in a panic, corporate credit found its way into programs, then municipals. Everything was couched in careful phrasing, indexes, facilities, special purpose vehicles, but the signal landed. If the core pipe sees, the backstop can stretch to meet the street. Once you've crossed that bridge, you don't unlearn the route. Balance sheets followed the language. Standing facilities sprouted where ad hoc windows had been. A standing repo ceiling arrived to cap funding spikes. Swap lines moved from novelty to normalized, with terms pre-negotiated and schedules routine. Even when usage was low, presence mattered. A posted rate reshaped private behavior more than 1,000 memos. If the ceiling exists, dealers price risk under it. If the swap line exists, cross-currency basis trades on the assumption of an exit ramp. Communication sealed the shift. Quantitative easing turned into balance sheet policy. Quantitative tightening became runoff consistent with ample reserves. The nouns are plumbing nouns. They describe architecture, not just stance, and they came with a new hierarchy of goals. Stability in plumbing outranked purity in signaling. If spreads blew out, the message would flex to calm pipes even if the headline target didn't move. That wasn't incompetence. It was path dependence, written by 100 close calls. Careers and reputations conspired toward absorption. No policymaker wants their name attached to a disorderly auction, a freeze in settlement, or a margin spiral. The safe move is to be early with a small intervention and declare victory. The risky move is to wait and risk a larger rescue later. Over a decade, the safe move wins meetings. The people who argue for restraint lose influence. The mandate edges forward in practice long before it changes in law. Incentives in the private sector mirrored that drift. Risk officers added footnotes. Access to central bank facilities if available. Boards asked, what's our contingency if repo specialness spikes? Banks rewrote contingency funding plans to assume the ceiling rate could be tapped by someone in the chain, if not them, then a counterparty. Repos were documented with broad substitution rights because eligibility might change mid-crisis. Everyone internalized the playbook. In stress, expand, absorb, announce dates, shrink later. Here's the loop nobody names in public. Temporary support expands the eligible collateral set. That expansion raises the moneyness of assets at the edge. Higher moneyness means lower spreads in COM. Lower spreads invite more leverage based on that COM. More leverage multiplies sensitivity to funding frictions. Funding frictions increase the odds that temporary support is needed again. Call it mandate engineering by inertia. No conspiracy, just feedback. Meanwhile, the legal language evolved with deliberate ambiguity. To ensure market functioning sits next to foster financial conditions consistent with our goals. That phrasing lets a central bank buy duration, lend specific collateral, or widen counterparties without admitting a new mandate. The clause is the obscure one markets learn to trade, stability as interpreted through functioning. It's clean enough for statutes, flexible enough for screens. Was there a choice? A true exit would have required thicker private intermediation, recalibrated leverage rules that rewarded depth, and a political tolerance for uglier prints during transition. That's a brutal bundle. It asks elected officials to wear volatility and regulators to cede control. Easier to keep the door ajar and promise you'll close it when the weather clears. The weather keeps finding clouds. Now think about culture. A generation of traders grew up with the blueprint. They've never seen a world without a standing ceiling, a swap line calendar, and a balance sheet as a policy dial. They run risk with that in mind. So do CFOs who manage liquidity with the assumption that collateral hierarchies can be softened by decree. So do pension boards who lean on margin lines they expect to roll because they've rolled through worse. Here's a micro story that tells it straight. A central bank lawyer drafts language for a new facility. The memo reads temporary measure to preserve market functioning. The PDF footer has an internal review date 6 months out. 2 years later, the footer has been updated 5 times. The facility's rate is unchanged, usage minimal. But a dealer's internal policy cites it as a reason to cut inventories by 10%. Why warehouse if the ceiling exists? That's how temporary became the plan, not with grand votes but with operational muscle memory. The blueprint hardened, the pipes were rerouted, and every small, rational decision on desks and committees across agencies pushed the system toward absorption over exit. Which leaves one question hanging over every screen. If this is the architecture, what actually triggers the moment everything snaps? The trigger set 5 plausible ignition points. So what actually lights the fuse? Not the grand catastrophe everyone imagines. It's always a small miss that hits the weak seam at the wrong hour. 5 ignition points, all plausible, each able to turn a tidy market into a margin call on the entire system. Ignition 1 starts with a basis trade that's supposed to be boring. Policy day lands, and the statement slips one sentence, no one expected guidance that hints at slower balance sheet runoff but a firmer path for policy rates. Futures lurch, cash bonds hesitate, and the spread that powers the basis narrows hard. The CUSIP everyone's short goes violently special. Repo rate spikes, term funding disappears, and desks rush to unwind. A few big players hit the same exit. Their prime brokers widen haircuts mid-move. Fails climb. What looked like pennies picked in daylight turns into a scramble to source collateral by close. The unwind bleeds into futures liquidity, basis hedges gap, and that friction transmits straight into risk parity and vol control funds that key off realized volatility. A tiny text in a policy paragraph becomes a citywide fire drill. Ignition 2 isn't domestic. It's a dollar squeeze that starts offshore. A political shock in an energy exporter, a sanctions rumor, or a downgrade in a big sovereign, pick your spark. Dollar borrowers rush to hedge through cross-currency swaps. The basis widens negative fast. Banks ration balance sheet for FX swap desks. Onshore, the swap lines exist, but accessing them requires banks to intermediate. Non-banks can't drink from that tap. Each roll costs more. Dollar liquidations start where they can, selling treasuries and agency MBS to raise greenbacks, just as the home market wrestles with collateral scarcity. Repo prints jump. A covered funding problem in Tokyo or Frankfurt becomes a collateral problem in New York by lunchtime. Ignition 3 arrives with a shrug, a sovereign auction that tails on technicals. The concession wasn't enough, coverage looks okay, but the distribution shows dealers swallowing more than they wanted. The next day, those same dealers lighten risk into thin secondary markets, pushing yields wider and swap spreads weirder. Real money balks at chasing. The following auction cheapens further and somebody says holiday liquidity on a microphone. Meanwhile, Treasury bills keep ballooning, hoovering cash into money funds and the central bank facility, starving street repo even as coupons need balance sheet. It's not a failed auction. It's a sequence of strained ones that force the dealer of last resort to decide whether functioning includes underwriting the calendar. Ignition 4 hides in credit plumbing. A credit ETF trades tight against its index until a single issuer shock pushes CDS wider. Delta hedging across ETFs, total return swaps, and options demands cash. Authorized participants redeem in kind, handing over bonds. Those bonds hit a dealer tape already thin, so discounts widen and NAV prints ugly. Margin calls ping leveraged longs, credit relative value funds, structured credit vehicles hedged with CDS, who sell what bids, treasuries, liquid IG tranches, even gold. Cross-asset vol steps up and collateral calls bite across desks that thought they were diversified. Variation margin is paid in the only currency that matters, today's cash. Liquidity concentrates where central bank facilities accept it and everything else sells. Ignition 5 is a policy clash in the FX channel. A country with a weakening currency faces imported inflation. The central bank hikes, talks tough, and starts discreet intervention to cap the slide. But domestic funding is already tight. Commercial banks, seeing volatility, shorten tenors and hoard top-tier collateral. Corporates with dollar liabilities rush to hedge at any price. The central bank burns reserves, then announces a technical adjustment to its liquidity operations. Markets read it as a tell. Cross-currency basis gapes, domestic yields jump in sympathy. The choice becomes stark: defend the currency and choke funding, or ease funding and invite depreciation. Either way, pipes creak and the stress exports through swap lines and risk appetite. Each of these is small, contained, until it touches the architecture we built. Basis trades rely on smooth repo. Dollar squeezes rely on accessible swap intermediation. Auctions rely on dealer capacity. Credit ETFs rely on market depth that isn't there when everyone redeems. FX defense relies on domestic liquidity that can't take the punch. The triggers rhyme because the pipes rhyme. Here's the setup payoff. One desk misses a margin call, one auction forces a concession, one FX fix runs long. That's the miss. The payoff is systemic because the backstop is the market now. The first 72 hours decide the map because that's how long it takes to reopen facilities, widen lists, and make the calls that stretch mandates without saying so. You won't get fireworks at the open. You'll get a day that looks annoying at 10 a.m., alarming by 2 p.m., and unforgettable by the close. The first 72 hours, playbook versus reality. Hour 0 starts with something small, a settlement miss that should have cleared by noon. It doesn't. Fails creep, then cluster in the same on-the-run issues the street needs to hedge everything else. General collateral lifts above policy by more than the morning's chatter can explain. Specials blow out. Prime brokers send quiet notes. Term is closed. Overnight only. Haircuts reviewed. Screens stop showing two-way risk. They show avoidance. A dealer who always answers on the first ring lets it buzz through. That silence is the first tell. 6 hours in, basis trades are unwinding in packs. Futures gap against cash. ETF NAVs disconnect a little, then a lot. Repo prints are erratic. 931 prints dear, 1107 prints dear, 1242 collapses when one fund dumps cash into a facility to make room. Variation margin emails hit inboxes like hail. A macro fund sells the liquid to protect the illiquid. Treasuries first, then IG credit, then the ETF that always trades. Liquidity concentrates in whatever the central bank will accept tomorrow if the list widens. That assumption guides the first wave of triage. By hour 12, prime brokers yank financing for specific CUSIPs rather than whole portfolios. We'll take your 5s, not your 7s. A clearing member flags rising concentration in fails and raises add-ons. The fails charge starts to matter, turning operational friction into real P&L. Dealers stop quoting size, they quote an option to talk. Risk officers cap gross balance sheet midday, a rule written after the last scare, now enforced by a spreadsheet that doesn't care about your conviction. The afternoon looks like a market, but it's just hedges trying not to drown each other. At hour 18, the secure bridge lights up. Emergency facility language gets drafted with blanks for dates and eligibility. If needed, the memo says, everyone on the call knows if already happened. The standing ceiling rate is discussed as a reference, not a binding cap. Someone suggests lending the specials that broke the pipes. A lawyer says our authority is broader than our habit. The room hears permission. This mirrors playbooks documented by the Fed, ECB, and BOE. Targeted operations justified under market functioning or financial stability clauses that have been stress-tested in public reports. 24 hours in, the announcement hits. Facilities reopened, terms familiar, stigma softened by careful phrasing. To support market functioning, eligibility widens a notch. One notch is enough to move models. A handful of banks tap immediately, not for cash but for the signal, a rate that draws a line under the panic, and a list that makes more collateral feel like money. The overnight prints settle lower, but term refuses to return. Participants are grateful and defensive at the same time. Hours 24 to 48 are about plumbing triage. Cross-currency basis gaps because dollar funding is dearer everywhere. The calls go out, swap lines tapped, schedules extended, settlement windows flexed. Central banks coordinate the message even if the words are different. A European desk asks for room to finance JPY hedged USDs. A US desk asks for patience on fails. An Asian desk wants clarity on haircuts if collateral comes cross-border. None of this is in the press release. All of it decides whether funding shows up before the next margin cycle. Meanwhile, politics wakes up. A finance minister calls a governor, "Are auctions safe?" A governor calls a treasury head, "Your bill calendar is starving repo." An opposition spokesperson tweets about bailouts in disguise. The comms teams craft lines that say action without admitting dependence. Words like transitory, technical, and precautionary reappear. Traders drink coffee and trade the subtext. Hour 48 brings the first compromise. Selective asset purchases begin, not QE, not by name, aimed at the clogged segments that anchor everything else. Long-end liquidity is offered in small clips at wide spreads. The purchases are conditional, rule-bound, and obviously targeted. The legal team stretches a clause that's been on page 47 for a decade. Functioning is the key that turns the lock. Screens breathe. It's not euphoria, it's relief that the floor stopped falling. The BOE's temporary gilt purchases in 2022 are the recent template. The Fed's 2020 facilities for USDs, MBS, and credit provided the broader precedent noted in BIS and FSB reviews. Inside one policy room, a governor argues the rules line by line. If we do this, we set precedent. Across the table, another stares at the market depth monitor and says, we either buy a little now or a lot later. Staff show basis curves, fails totals, and a chart of GC minus policy that won't fit on one axis. The argument ends the way these arguments end, with a narrow intervention today and a promise to review tomorrow. Hours 54 to 66 are cleanup and triage for the periphery. Small central banks mirror the facilities with their own versions, some tapping foreign lines to pass dollars through domestic pipes. Emerging markets sell reserves to stabilize FX, and in doing so sell core bonds into a still thin market. That liquidation pushes yields in the core higher, forcing another round of targeted support. The loop is tight. Support at home causes strain abroad. Strain abroad sells the same collateral you just tried to stabilize. By hour 72, the surface looks calmer. GC trades closer to policy, specials retreat from absurd, and fails plateau, still elevated but no longer rising. The list of eligible collateral is longer than it was on Monday. The stigma of the window is lighter than it was yesterday. The precedent is heavier than it was ever meant to be. Desks reopen term cautiously. Risk officers keep the new limits. The market survived, but it learned a lesson it already knew. When the pipes crack, the referee plays the ball. That's the playbook meeting reality. The plan says backstop, then exit. The market hears backstop, then maybe. The next phase won't wait. Containment at home always triggers shock abroad because the collateral is the same and the funding channels are shared. The map of winners and losers starts drawing itself in the balances of who can borrow at the window, who can pledge what, and who got the call back before the close. The domino map: who falls, who absorbs, who arbitrages. Containment at home loosens screws abroad. The same collateral sits in different jurisdictions, and funding habits travel faster than statements. Coordination begins with a familiar choreography. US, EU, UK, and Japan ring each other first. Swap lines expand hours, not days. Press releases land within minutes with slightly different verbs that say the same thing: functioning matters. Behind the language, they triage which pipes to fill and which to leave thirsty. The priority is simple: Keep sovereign curves tradable and settlement working, then argue philosophy later. This cadence mirrors the coordinated swap line enhancements seen in March 2020 and March 2023, documented by the Fed and BIS. Smaller central banks don't get the luxury of timing. They're forced to follow. If the dollar prints dear in New York, a South African dealer pays up in Johannesburg by afternoon. If Tokyo lends dollars through a swap line, Seoul must mirror or watch basis gaps yank corporate hedges wider. The periphery's toolkit is shorter: FX intervention, reserve sales, local repo tweaks, and every choice leaks pressure into the same core markets. Selling reserves means selling treasuries and bunds. Those sales land in the thin tape you just tried to stabilize. Emerging markets face the ugliest trade. Currency gaps widen as locals hoard dollars. Corporates with FX liabilities scramble to roll hedges at exact moments. Basis spreads punish them. Central banks dip into reserves to slow the slide, and each dollar they raise is a bond someone else must buy. Reserve liquidation isn't a headline, it's a persistent offer in core futures that keeps rallies from sticking. That drip higher in yields feeds back into domestic borrowing costs, and the loop tightens. In the private sector, insurers and pensions become involuntary sellers of the liquid to defend the illiquid. The playbook is the same in London, Frankfurt, and Toronto. Post cash, protect the derivative hedge, sell what trades. They dump on the run sovereigns, IG ETFs, and index futures. That pushes spreads and specials around precisely when funding desks hoped for calm. Risk parity funds delever because realized vol cross tripwires. Vol control strategies shift allocation at the close. The mechanics are clinical and merciless. Prime brokers ration balance sheet to clients who make their lives easier, transparent, well-margined, quick-to-meet calls. Clients who delivered in prior squeezes get a phone call and a little patience. Everyone else gets term cut and haircuts up, no second chances. Clearing members add idiosyncratic add-ons for operational risk. A polite way of saying your name appears too often in the fails log. It's not moral judgment, it's survival triage. Winners emerge early. Balance sheet light funds with dry powder, macro funds that held cash, event-driven shops that underwrote with minimal leverage step into dislocations others can't touch. They buy the mispriced basis when futures overshoot cash, the off-the-run that's gapped too far from the on-the-run, the FX cross where basis implies panic. They don't need repo, they cross collateral light trades through prime desks grateful for order flow that doesn't eat capital. Dealers with exemptions, temporary, targeted, and hard-fought, play a different game. A waiver on supplementary leverage ratio, a relief on GSIB buffers, or a nod on internal risk weights gives them inches that matter. With those inches, they warehouse a little more, make two-sided markets in clips the rest won't quote, and collect spreads that looked impossible last week. They're not heroes, they're paid to hold umbrellas in a storm no one else can stand in. Losers are predictable and painful. Maturity mismatched funds that funded long with rolling short get squeezed first. Mortgage REITs that relied on calm repo see funding costs detach from speeches. Corporate treasurers who sold FX forward to smooth earnings find the roll dearer and collateral hungrier. Utilities that hedged fuel with swaps face margin they didn't budget, so they cut capex or tap backstop lines that come with politics attached. Everyone discovers which line items were assumptions, not guarantees. Microstories bloom in the chaos. A Scandinavian insurer calls its US custodian. Can you transform this off the run into something the central bank will take if we need it? The custodian says yes with fees that bite. A Japanese lifer looks at US duration hedged back to yen and decides to wait. The cross-currency basis makes the math ugly. A Middle Eastern wealth fund rotates from long-end treasuries into bills, happy to clip certainty while the dust settles. Each move is rational alone, together they rewire flow. Coordination among majors absorbs the first shock, but it also arbitrages new seams. A US bank taps the standing repo, funds a European affiliate, who passes dollars to a local client at a spread that looks fat and fair. A UK dealer borrows gilts against agencies through a collateral upgrade chain that earns 3 basis points 80 times a day. A Swiss desk packages balance sheet light basis trades into notes for clients hungry for carry with a story. The trades aren't new, the spreads are. Meanwhile, policy lines blur into strategy. Central banks insist interventions are temporary. Markets treat them as rate corridors in the plumbing. The standing ceiling becomes a price, not a story. Eligibility lists become shopping lists. The institutions that memorize those lists earliest print money by staying inside the rails while others test the fences. Arbitrage in a crisis isn't daring, it's compliance with better timing. When the dust starts to settle, the map is redrawn. Core banks that stayed liquid gain clients. Funds that met every call get larger mandates. Balance sheet light winners write letters about discipline. Losers draft side letters with tougher covenants, higher liquidity buffers, shorter notice periods. The periphery carries scars in FX and reserves. The core carries a longer collateral list and a shorter memory. Markets stabilize, but the mandate doesn't come back the same, and neither do the incentives. The reveal: mandate rewritten in the fog. The first clue isn't a headline, it's a footnote. Operations conducted to support market functioning. That phrase shows up in a statement that used to mention only inflation and employment. Traders don't need a trumpet. They see the vocabulary change and know the mandate moved without a vote. Press conferences become the theater of admission without confession. A reporter asks, "Is this quantitative easing?" The governor replies, "These are temporary targeted purchases to preserve market functioning." Another asks, "Are you prioritizing stability over inflation?" The response, "Our actions support the transmission of policy to achieve our goals." It's clean, it's careful, and it concedes everything that matters to desks watching collateral lists expand in real time. Policy pivots are now instruments, not slogans. A standing repo facility once described as a ceiling starts to look like a spine. The eligible collateral list inches wider off the runs that were second-class money last quarter now clear at first-class rates. Term windows extend past month-end, past quarter-end to avoid distortions. Swap lines get more frequent roll dates and fatter allotments. Corporate desks hear the message. The door is open and the frame is wider. In the fog, the price of peace is set, not declared. Inflation tolerance doesn't get a new target, it gets a new rhythm. Bands matter more than points. Prints that would have drawn hawkish fire a few years ago now get described as consistent with our path. The street reads the tell. If curve stability and settlement reliability require a little drift, drift will be accepted. That's a de facto band widening paid in basis points and language. Governance adapts to justify outcomes already chosen. Independence is reframed as dual stability. Price stability and financial stability co-equal in practice if not statute. Committees add a line to their remit, monitoring market functioning metrics alongside inflation expectations. Internal dashboards make it explicit. Fails, GC- policy, swap spreads, auction tails. These are the risk indicators that move decisions at the margin. The hierarchy of concerns flattens. Instruments get codified where improvisation used to live. The standing repo is no longer an emergency measure. It's a permanent corridor tool. Collateral transformation through official channels becomes standard. Central clearing, term schedules, substitution rights that treat eligible today, eligible tomorrow as policy. Targeted asset purchases are written with triggers. Volatility bands, liquidity thresholds, operational constraints that sound technical and are political. Everyone pretends the line is bright. Everyone knows it's drawn with a pencil. The human angle is right there on stage. A governor avoids the word intervention and says operations. Another uses temporary 5 times in 2 minutes. A third leans on proportionality, which is code for we won't buy more than needed but we'll buy. When pressed, they say we have the tools. Markets here, we are the tools. The admission sits in tone, not text. Banks adjust their playbooks overnight. Treasury desks tag collateral by official moneyness, scoring what's most likely to be financeable under the facility in a pinch. Insurers rewrite liquidity addenda to include central bank eligibility as a top criterion. Pensions instruct LDI managers to preposition the right CUSIPs at custodians who can flip them into the window with a phone call. This isn't cynicism. It's survival in a system that made the referee the dealer. The ripple hits issuance calendars. Debt offices space auctions to align with facility roll dates quietly. Dealers push for maturities that pair well with facility terms quietly. Technical factors in statements now cover calendar choreography between fiscal and monetary arms that don't coordinate officially but absolutely coordinate in the plumbing. The mask stays on, the audience knows the actor. Metrics enter public life that used to live in back offices. Facility usage appears in dashboards watched by retail traders. A quiet lift and take-up stops being stigma and starts being signal. Journalists begin parsing basis curves and fails like unemployment rates. When a remittance to the Treasury halts because deferred assets eat central bank income, the debate goes mainstream. Can an institution with negative carry keep buying calm? The Federal Reserve's recent suspension of remittances and accumulation of deferred assets, and similar episodes at other central banks, have already sparked public discussions about the fiscal optics of prolonged balance sheet policies. Meanwhile, lawyers do the invisible heavy lifting. A clause about ensuring the smooth functioning of payment and settlement systems becomes the legal backbone for buying the exact maturities that anchor benchmarks. Another clause about acting as lender of last resort to solvent institutions stretches to include solvent markets with insolvent liquidity. These are not overreaches. They're reinterpretations tuned to the world that exists, not the one the frameworks imagine. There's a cost nobody lists on the balance sheet. Optionality moves from private hands to public policy. Dealers hold less inventory because the facility is there. Funds run tighter liquidity because eligibility is a parachute. Corporates sit shorter because rollover comfort is engineered. The system works until the day capacity collides with credibility and the next fog requires brighter lights. The reveal isn't a scandal, it's a sentence. When financial stability graduates from a paragraph to a pillar, the mandate is rewritten in the fog, not with a gavel but with a glossary. And once markets price that new dictionary, the next chapter won't be about whether the backstop returns. It'll be about who lives under its roof and who gets left outside when the list closes at 4. The real economy, how the plumbing hits paychecks. The screens go green again, but the invoices don't. Transmission bends where people live. Banks tighten credit standards quietly, higher DSCRs, tougher covenants, shorter maturities. A small manufacturer walks into a review expecting a rollover at 175 over and leaves with 275, a 50% increase in spread and a term cut from 3 years to 12 months. The lender shrugs, funding costs moved, liquidity buffers come first. The project still pencils barely, hiring goes on hold. The owner drives home doing math at red lights, what to cut, who to call, how to explain funding conditions to a crew that hears hours. Households feel it through a door they don't watch. Card APRs float faster than deposit rates rise. HELOCs priced off overnight funding tick higher with every microspike in repo, not just policy meetings. A borrower with a variable mortgage sees the reset letter arrive 2 weeks sooner than planned because the securitization deal behind the loan lost its bid for term funding and the servicer moved the calendar. Nothing broke. The cost of time just got repriced. She opens the envelope at the kitchen counter, stares at the new payment, and moves a dentist appointment to later. Utilities and transport pass through hedging costs with a lag that feels like a fee. A power company rolled its fuel swaps in the week spreads blew out. The margin swing drained their cash buffer, so they bumped customer rates by a sliver and delayed maintenance that would have shaved losses in winter. A shipping firm that hedged bunker costs and options finds the premium doubled on the next roll because volatility is the new tax. Tickets go up, routes get cut, contingencies multiply. You don't see margin call on a bill. You see a few more dollars and a note about extraordinary conditions. On shop floors, the volatility premium shows up as a new line item, supplier stability. A parts maker that used to demand net 60 now insists on net 30 and a small prepay. They're not ruthless. Their bank shaved their working capital line by 15% after internal stress tests flagged market functioning metrics. That phrase won't reach the workers who unload pallets, but it will reach their hours. Overtime becomes rare. Quits fall not because people are thrilled, but because job hopping feels like stepping into thinner ice. A supervisor prints schedules with fewer blanks for swaps. A sticky note says no OT this month. Wage bargaining adapts to the drift. Unions that aimed for headline inflation plus a point start asking for indexing bans and mid-contract reopeners. Management counters with one-time payments and tighter productivity clauses. Both sides are pricing persistent frictions, freight more expensive, credit more conditional, inventory stickier. The result is a labor market that looks steady in headlines and stiff in hallways. Raises arrive, benefits chip away, schedules get rigid. The volatility premium gets socialized. People stop asking when does it ease and start asking what's the new normal. There's a micro story in a town that doesn't make the news. A Midwestern metal stamper won a contract to supply casings for a medical device. The machinery is on order, the floor is marked. Mid-project, their working capital line resets. The new rate is manageable, but the advance rate against receivables is trimmed 5 points and the bank asks for a weekly liquidity update. The CFO cancels the second shift's expansion and phones the vendor about extended terms. The vendor says yes, with a discount that eats the janitor's raise. The CFO writes sorry next to raises deferred on a legal pad and circles rent. Small businesses feel the covenant creep. What used to be maintenance tests, interest coverage, leverage, now include liquidity tests keyed to market functioning indicators. Breach the cushion when GC prints above policy for a week and your pricing ratchets until you post cash. The owner of a regional restaurant group pushed back until the lender emailed a chart of fails alongside a revised term sheet. She signed. 2 locations stay dark on Mondays for staff wellness. The staff hears the new phrase and knows it means hours down. Meanwhile, fiscal spillovers reach city budgets. Debt service on short-dated notes the city rolled for years suddenly cost a handful of basis points more than advertised, and auctions clear with thinner coverage. The finance director pairs capital plans, defers a school roof, and calls the transit authority about adjusting service to ridership. Riders hear fewer trains. A local contractor loses a bid they would have won in Commer pipes. The mayor practices a sentence that doesn't mention collateral. Corporate treasurers short maturities to dodge squeezes, and that preference trickles down the chain. Suppliers get paid faster, good news, until the day the dealer window clogs and term disappears. Then payments slow just a week, but payroll is monthly and insurance premiums are not negotiable. HR sends a nice email about aligning cycles. People grumble and adjust. The friction becomes normal. The receptionist moves bill due dates around like chess pieces. Insurance premiums creep higher for reasons no spokesperson will state plainly. Capital charges on market risk rose after the last wobble, liquidity add-ons tightened. An insurer reprices cat coverage and auto liability by a few percent to preserve buffers. The household budget absorbs it in groceries and school shoes. Nobody connects it to collateral scarcity, everybody feels it. The family spreadsheet gets a new column, maybe next month. Post-event policy notes from supervisors and the FSB on NBFI resilience and liquidity risk management have a way of translating into higher buffers and costs that filter into premiums. Politically, the question writes itself. Who got saved? A talk radio host says hedge funds, a minister says pensions, a central banker says market functioning. The real answer is less tidy. Pipes were stabilized so mortgages could reset in an orderly line and payrolls could clear. But the optics are brutal. Populist pressure builds for windfall taxes, for rate caps on cards, for bans on speculation. Some proposals land, adding frictions to pipes already creaking. The next wobble will carry more rules and less patience. Entrepreneurs learn new strategies. Keep cash dry, take less term risk, negotiate covenants like you're buying an umbrella in August. Builders stagger projects to match rollover calendars. Tech founders raise a little more than needed and keep it in treasuries they can repo on demand. Farmers pre-buy inputs because their co-op's credit line carries a new clause about market stress events. Every adaptation is rational. Together, they freeze a chunk of investment that would have chased growth. Ideas wait for windows, windows wait for pipes. This is how plumbing hits paychecks. Not with a crash, but with a grind, higher risk premia baked into everyday contracts, flexibility traded for certainty, time made expensive. The backstop saved the screen. The street rewrote its rules, and the cost leaks into rent, rates, receipts, and raises 1 basis point at a time. You don't see the facility on your statement. You see the late fee you didn't pay last year, the raise that's under review, and the calendar that keeps moving toward you. The new equilibrium, financialized sovereignty. When the fog thins, a new rulebook sits on every desk. Sovereignty now runs through funding screens. Governments still legislate and tax, but the true constraint is how easily their paper moves through the pipes. Market functioning isn't a footnote anymore, it's the anchor. Policy gets written with one eye on inflation and the other on collateral. Start with the pact nobody signs. Fiscal sets the issuance calendar, monetary calibrates the plumbing so that calendar clears. Independence survives as tone, interdependence rules as practice. If auctions bunch near quarter end, facilities quietly extend term past quarter end. If bills crowd out dealer repo, the ceiling rate nudges behavior just enough to keep GC near policy. Call it choreography, call it survival. Either way, the duet replaces the solo. Collateral becomes a hierarchy with sharp edges. At the top sits what the facility will take tomorrow morning without a phone call, on-the-run sovereigns, clean agencies, a handful of Supras. Next are off-the-runs and seasoned paper that clear fine and calm and turn awkward in stress. Below that, high-quality credits with haircuts that flex when specials spike. The line between money and not money is no longer theory. It's an eligibility list updated on a Thursday. That list reshapes banking. Dealer of last resort goes from posture to posture and process. Banks carry less warehoused inventory and more encumbrance capacity. Balance sheet is reserved for two things: client flow that can be hedged against the facility's spine and collateral that transforms cleanly if the window opens. The traditional originate and distribute becomes originate, tranche, and preposition. Private intermediation doesn't vanish. It shrinks to what can be financed under the umbrella. Corporate finance follows the pipes. Treasurers short maturities not out of fear, but because the premium for term is a tax they can't justify to boards that now measure liquidity as a KPI. Covenants tight with market functioning, triggers that let lenders reprice when GC drifts or fails spike. Liquidity buffers grow as a share of assets, parked in securities that double as collateral at the facility. Cash management turns into collateral management with payroll attached. Households live the slow drift. Variable rate credit becomes the default risk-sharing mechanism. Mortgage markets, engineered for smooth securitization, tilt toward shorter resets and wider spreads that reflect the volatility premium in funding. Inflation doesn't scream, it hums 2 ticks above comfort, explained away as consistent with our band. The band isn't official, but everyone knows its rhythm: don't break the pipes. Sovereignty leans into finance because finance now sets the margin for sovereignty. Debt offices design auctions around dealer capacity metrics, spacing tenors to match collateral transformation slots. Issuance tilts to whatever the market will treat as money tomorrow. The reward is stability, the cost is policy space. A budget line that looked optional last year becomes non-negotiable because the market demands a certain profile of paper. Elected officials discover that maturity is politics. Internationally, reserve currency privilege deepens by dependence. The issuer of the most accepted collateral sets the global heartbeat. Swap lines institutionalize that privilege. Dollars flow through friendly pipes on schedules that favor the core. Periphery sovereigns adapt by building local collateral frameworks, domestic standing repos, broader eligibility to mimic the center. But their money trades at a discount, and the discount is collateral quality, not just credit. IMF and BIS research on cross-currency basis and reserve usage repeatedly highlights this structural asymmetry. In the new equilibrium, risk migrates to design. The central bank's corridor in the plumbing is the operating system, developers write to it. Funds package facility-adjacent carry as a product, harvest the spread between eligible collateral and the ceiling with clauses that step aside when lists change. Banks sell balance sheet light intermediation, cross assets that share eligibility, hedge with futures that sit on the corridor's rails. Everyone prices the pencil marks as if they're ink. Language keeps the peace. Statements talk about ample reserves and effective transmission, while internal dashboards watch fails and tails. Temporary remains the adjective of choice applied to windows that never close, lists that only widen back to the last crisis, and operations that roll with calendar regularity. The market nods and behaves because the alternative is learning to live without the spine that now holds everything upright. There's a cultural shift you can feel on late calls. No one asks, will they step in? The question is, where's the line today? Traders memorize the facilities terms the way they once memorized Taylor rules. Lawyers carry the obscure clause like a talisman. Treasury officials brief lawmakers on market functioning indicators before votes. The vocabulary of sovereignty is financial now: eligibility, encumbrance, transformation, term. Opportunity survives in the edges. Firms with low leverage and patient capital arbitrage dislocations that the corridor creates, buy what the facility won't touch yet but probably will next time. Corporates issue hybrid structures that score as equity for ratings and as collateral light for banks. Municipalities ladder shorter debt and prearrange repo lines with state pools that mirror central bank terms. Innovation doesn't stop. It roots around capital charges and eligibility tables. The risk is simple and hard: capacity versus credibility. Each time the corridor saves the day, belief accrues that it can absorb any shock. Each time lists widen, collateral inches closer to money. If a day comes when the pipes need more elasticity than the mandate can supply without political cost, the equilibrium will test the roof. Until then, financialized sovereignty holds. The state governs by keeping its debt liquid, the central bank governs by keeping that liquidity credible, and the rest of us learn to live where functioning outranks purity. The decades plan who wanted this and why it sticks. Follow the incentives and the path looks less like a conspiracy and more like a coalition. Issuers wanted elasticity. Intermediaries wanted optionality. Incumbents wanted predictability. Each group learned crisis by crisis that market functioning could be engineered, and once engineered, defended. Start with the biggest beneficiary, sovereign issuers. When your debt stock is the global benchmark, liquidity isn't vanity, it's policy. A smoother curve lowers borrowing costs, widens your investor base, and keeps your fiscal math printable. Each time the pipe seized, 2008, 2011, 202 debt offices came away with the same lesson. The cheapest insurance is a central bank prepared to stabilize the core. They didn't write the mandate, they priced it. Auction calendars lengthened, syndications diversified, and issuance tilted toward maturities that pair neatly with official facilities. Stability shaved basis points. Basis points saved budgets. Intermediaries, banks, dealers, prime brokers found their own dividend in the drift. A permanent corridor in the plumbing turns balance sheet into a franchise. If you can borrow at the ceiling and lend inside it, eligible collateral becomes a product you can manufacture, transform, and rent. The business model shifts from inventory risk to collateral engineering. That's safer for capital, friendlier to regulation, and lucrative when spreads fracture. Each expansion of eligibility created fee lanes, sponsored clearing, collateral upgrade chains, term transformation that incumbents were best placed to run. Asset managers benefited through scale and narrative. Liquidity-aware strategies sounded like prudence and sold like safety. Funds marketed access to the most financeable assets, the shortest roll risks, the tightest operational lines. Mandates grew around those features. Meanwhile, benchmark providers tilted toward securities that sat inside the corridor, reinforcing flows that rewarded the biggest issuers and the most facility-adjacent instruments. The loop fed itself. Eligibility begat index weight begat issuance, issuance begat eligibility. Then there's bureaucracy's momentum. Mandates expand, rarely shrink. After each scare, committees added metrics, dashboards, and escalation trees. Careers aligned around being early to stabilize and late to withdraw. The institutional memory that argued for restraint retired, the cohort trained in temporary rose. Legal teams wrote flexible clauses, communications teams road-tested the language, operations teams built muscle memory. The machine learned to act because the last episode proved action was survivable and popular with the people who mattered in the room. And look at international incentives. Reserve currency privilege isn't maintained by speeches, it's maintained by collateral everyone wants. A central bank willing to be dealer of last resort for the benchmark asset locks in global dependence. Swap lines formalize that dependence among friends. For allies, the arrangement is security; for the issuer, it's leverage. That geopolitical dividend sanctions power, crisis diplomacy, funding resilience, rests on the same pipes the mandate now guards. Undoing the corridor would mean undoing a core tool of statecraft. Narrative did the quiet work. Stability took on a broader meaning after each episode, absorbing asset prices without ever saying so. The public heard jobs and inflation. Markets heard spreads and settlement. Press conferences never promised floors, they promised functioning. But the effect was the same, a low volatility regime in core rates interrupted by brief storms that justified the next tweak. Investors who called it moral hazard got labeled cynical. Those who called it modernized central banking got invited to panels. The evolution is reflected across IMF GFSRs, BIS annual reports, and FSB progress notes that increasingly frame market functioning as an operational prerequisite for transmission. Who wanted this? Not a cartoon villain. A coalition of rational actors who each gained from a system that internalized liquidity risk at the center and exported its costs in slow drips. Issuers shaved dozens of basis points off trillions. Intermediaries harvested steady fees with less capital at risk. Asset managers scaled products that fit the corridor. Politicians avoided funding accidents on their watch. Central bankers preserved transmission by preserving pipes. Nobody needed a back room, they needed time and a dictionary. Why does it stick? Because the exit bill is steep and the benefits are concentrated. A true reversal would require thicker private market making, leverage rules that reward warehousing safe assets, and a tolerance for uglier prints while depth rebuilds. It would mean auctions that fail occasionally without a career ending, ETFs that gap without a hearing, and pension boards that accept wider ranges in quarterly marks. In other words, pain up front for resilience later. That's a brave policy in a quiet year and a suicidal one in an election cycle. Internationally, exits are even harder. If the core loosens the umbrella, periphery funding costs jump first. Reserve managers would liquidate again, reinforcing the very fragility the exit seeks to cure. The issuer of the world's collateral would sacrifice a geopolitical advantage for theoretical purity. No committee signs that memo unless forced. There's a counterfactual path: slower issuance when depth thins, auction innovations that spread risk, regulatory recalibration that frees balance sheet for market making, and ring-fence support that expires for real. It exists. It's just unlikely without a crisis that punishes the current design in ways voters can see and leaders can't dodge. Until then, the corridor endures. So the decade's plan isn't a plot, it's path dependence with beneficiaries. The mandate widened because functioning was saved. Functioning was saved because the coalition needed it. The coalition needs it because their models, budgets, and strategies now assume a spine in the pipes. That's why the fix repeats and the list rarely shrinks. The center holds by choice, by habit, and by incentive. Signals to watch: reading the next fracture early. Start with the tells the pipes reveal before headlines do. Special repo spikes in benchmark CUSIPs, fails clustering for more than a day, and GC drifting above policy by a stubborn spread. Those are alarms. Watch the gap between GC and the standing ceiling. If it persists, elasticity is thin. Basis hiccups that line up with auction days mean capacity is rationed. These are the same micro-indicators tracked in BIS market functioning dashboards and echoed in central bank market intelligence notes. Policy tells arrive in footnotes. Collateral eligibility nudges wider, term windows extend for technical reasons, and facility stigma fades as take-up normalizes. Issuance tells are blunt: bill share rising, auction tails widening, primary dealer allotments swelling. Balance sheet tells sit in statements, deferred assets climbing, remittances to the Treasury halting, capital buffers footnoted. Politically, temporary and functioning get sticky again. Put them together and you'll see stress building before screens scream. When the referee becomes the field, outcomes aren't neutral, they're managed. Subscribe if you want the map of who's positioned to win this regime. Then watch our next episode on the quiet beneficiaries hiding in the plumbing.